Valuation ratios are like financial X-rays for stocks. They help us peek inside a company's financial health and determine its worth. Think of them as tools to compare different companies, much like you'd compare apples to apples. By understanding these ratios, investors can make smarter decisions about buying or selling stocks. These ratios are crucial for evaluating a company's current share price relative to its earnings, sales, or other key metrics. Essentially, they provide a standardized way to assess whether a stock is overvalued, undervalued, or fairly priced. However, remember that ratios are just one piece of the puzzle. They should be used in conjunction with other financial indicators and qualitative factors for a comprehensive analysis. Just like you wouldn't judge a book by its cover, don't judge a stock solely on its ratios. One of the most popular valuation ratios is the price-to-earnings (PE) ratio. This ratio tells you how much investors are willing to pay for every dollar of a company's earnings. Calculating the PE ratio is simple. Divide the current market price per share by the company's earnings per share, EPS. A high PE ratio could indicate optimism about future growth, while a low PE might suggest undervaluation. Compare PE ratios within the same sector for meaningful insights. When it comes to valuation ratios, is low always better? Not necessarily. While a low ratio might seem like a bargain, it's essential to understand the reasons behind it. A company with a low PE ratio, for instance, might be facing financial difficulties, have poor management, or operate in a declining industry. On the other hand, a high valuation ratio could be justified if the company is experiencing rapid growth, has a strong competitive advantage, or operates in a high-demand sector. The key takeaway is that context matters. Don't blindly chase low ratios or shy away from high ones. Dig deeper, understand the underlying reasons, and then decide if the valuation is justified. Remember, investing is not about finding the cheapest stocks, but about finding the best value for your money. Unveiling the price-sales ratio. The PE ratio has limitations, relying on earnings that can be manipulated. The price-sales (PS) ratio compares market capitalization to annual revenue. It shows how much investors pay for each dollar of sales. A low PS ratio might indicate undervaluation but doesn't consider profitability. Use it with other metrics like gross margin and net income margin. Section 5, EV/EBITDA, a deeper dive into enterprise value. The enterprise value (EBITDA, EV/EBITDA ratio takes a more comprehensive approach to valuation by considering a company's debt. It compares a company's enterprise value, which represents its total value, to its earnings before interest, taxes, depreciation, and amortization, EBITDA, a measure of its operating cash flow. The EV/EBITDA ratio is particularly useful when comparing companies with different capital structures or debt levels. A lower EV/EBITDA ratio generally suggests that a company is relatively undervalued compared to its peers. However, like other ratios, EV/EBITDA has its limitations. It doesn't account for capital expenditures, which can be significant for companies in capital-intensive industries. Therefore, it's crucial to consider industry-specific factors and other financial metrics when using the EV/EBITDA ratio. Section 6. The siren song of cheap stocks. Proceed with caution. While it's tempting to load up on stocks with low valuation ratios, remember that cheap can be deceiving. Sometimes stocks are cheap for a reason. Companies facing declining revenues, increasing competition, or regulatory hurdles might see their stock prices plummet, resulting in seemingly attractive valuations. Before jumping on the cheap stock bandwagon, conduct thorough research, analyze the company's financials, understand the industry dynamics, and assess the management team's track record. Remember, investing is not about finding the cheapest stocks, but about identifying those with the greatest potential for long-term value creation. Section 7. Navigating the valuation maze. Key takeaways. Valuation ratios are powerful tools for investors, but they're not a magic bullet. Understand what each ratio tells you, its limitations, and how to use it in conjunction with other financial metrics. Remember, a single ratio rarely tells the whole story. Consider the company's industry, growth prospects, management team, and overall market conditions. Investing is not just about crunching numbers, it's about understanding the underlying business and its potential. By combining your knowledge of valuation ratios with thorough research and a long-term perspective, you can navigate the stock market with confidence and make informed investment decisions. Remember, in the world of investing, knowledge is power.